Hey, everybody, Tom Gentile here. Welcome to my Profits and Patterns podcast, the 3 Ps. I could think of 7 Ps, but we'll discuss that another time. Patterns and Profits podcast, Friday, May 25th, 2024. I'm going to say it now, and hopefully I can remember to say it again before we sign off. I hope you guys have a fantastic Memorial Day weekend ahead of you. I'm certainly hoping to do so, but I thought I'd spend a little time with us before I shut down the computer, shut everything off, turn the lights off, lock the door on my way out. And yeah. So, I mean, I got 3 things I really want to talk about. I mean, first of all, America's pattern trader. Yeah, that's me. And I say that not to pat myself on the back, but I kind of have to because, we're ending the month of May. The way we looked at it was the way everybody else didn't look at it. We were right. They were wrong. But also, how about that GME trade I did last week? If you listened to last week's podcast, it was a real time, but a not real time trade. It was real time for me because I did this on Wednesday of last week. And I took a trade in real time. You got the podcast on Friday, just like you're doing this Friday. By the way, I'm recording this early as well. But by the time you got it, the trade was over. But you got to see how I did because this thing could have went against me just as much as it went in my direction. It did go in my direction. And that pattern that's happened time and time again proved to be the right way to take GME again. Where's GME at today? Don't know. Don't care. It's not a pattern right now. So I don't want anything to do with it. So, but if you want to see it, where are we? 2 minutes in the recording. I'll post it. I'll post it in, you'll be able to get it either on email or you can see it in the video. 2 minutes and 30 seconds in. I'm writing that down. Okay. So that's the first thing I wanted to cover. Look at that. The way we're going, this podcast is going to be over inside of 10 minutes. I don't think so. Here's another thing. Bitcoin and Ethereum having another moment. Now, I said Ethereum would become the next alpha. You remember that? You remember? Huh? Do you remember? Okay, let me take you back. Back at the beginning of the year, it was all about Bitcoin. It was all about the SEC approval of the spot ETF products. And Bitcoin was outperforming Ethereum. And then it had its moment. And I said, expect Ethereum in the not too distant future to become the alpha of the 2 coins, to be the one that was the mover. Well, it took us February, March, April, May, 4 months before that started happening. But earlier this week, it did just that. It jumped 20% in less than 24 hours. Go back and look what happened between Monday and Tuesday. And that's because there was a little something that came out from Bloomberg that said the odds of an SEC-approved Ethereum ETF just increased. Now, today, they're supposed to have a ruling on this. Now, I'm not recording this on Friday. I'm recording this early because we got a big weekend coming up. But I don't know the outcome. So you're listening to this. Maybe you're hearing the outcome right now. But you know what? They were supposed to approve the Bitcoin ETF, and they kept postponing it. So it would not surprise me if they came back and said they needed to postpone it a little bit more, but maybe not. By the time you're hearing this, you will know the answer. Now, how about the outcome? I don't know the outcome, and I don't know the outcome of Ethereum because, again, I'm podcasting this early. So we can look at this one of 2 ways. Buy the rumor, sell the news. Just like Bitcoin did in January. Expect Ethereum to pop and drop on the news announcement. So let me take you in the Wayback Machine, and let's go way back to the beginning of January. All right, we just got through New Year's. We're in the first week of trading, and we know that SEC ruling is coming out shortly. Bitcoin was going up at the time, and once that SEC ruling came back in positive, Bitcoin hit 48,000 very, very quickly. There's the bell. 48,000. Well, guess what happened after that? It dropped over 20% in the 2 weeks following the ruling. So just saying, folks, be ready, okay? Be ready for Ethereum to do the same thing. I'm not saying it's going to do it, but it might, okay? Now, here's a better idea, and the one I favor even more. How about we, instead of buy the rumor and sell the news, how about we hopefully buy before the rumor, stay long the rumor, stay long the news, and stay long the aftertaste, because the aftertaste is sweet. I fully expect Ethereum is going to do the same thing Bitcoin did. So I want to tell, let's take a look at it here. Let's take a look at Ethereum for a second. Well, what did Bitcoin do? Well, Bitcoin, it hit 48,000 shortly after the SEC ruling, okay? And it did that 20% pullback. But 2 months later, 48 was eclipsed and became 73,000 in 2 months after the ruling. Go look at March. See what happened in March with Bitcoin, okay? Now, why could this happen? Well, a couple of things. We're in the middle of a 4-year cycle. All right, so we're in the middle of the 4-year cycle. We're on the bullish side of the 4-year cycle. We're in the bullish half of the 4-year cycle. That began in 2023. So you got 2023, 2024, and part of 2025. That cycle should continue to go up if history repeats itself. There's also the post-halving of Bitcoin. Well, what has this got to do with Ethereum? Well, if you haven't figured it out, and you haven't, then do this. Take a chart of Ethereum and take a chart of Bitcoin, layer them on top of each other, and you'll see they both move pretty much in the same direction. So, you got the 4-year cycle, you got the post-halving, and we got what happened with the SEC ruling of Bitcoin, and we can apply that to Ethereum. Now, I know some of you are thinking this, Tom, are you saying that Ethereum is going to reach all-time highs above 4,800 in 2 months? No, I'm not saying that, but it is possible, okay? It is possible. So there we go, guys. Hey, it's, again, I'm only 8 minutes in my podcast, and I got 2 of the 3 things I wanted to talk about out of the way. They're gone. So for those of you that comment that I'm long-winded, that I take forever to get across whatever it is I want to say in my podcasts, that's for you. This last one, though, it's going to take a few minutes. It's going to take a few minutes. Okay, so what I really want to talk about in today's podcast has to do with William Devane. Now, how many of you, and you can comment on this if you can, how many of you know who William Devane is? All right, I'm going to serve it up to you. This guy was the heartthrob in the 1980s. And he was a star of Knots Landing, or one of the stars of Knots Landing. And I had to look that up because I couldn't remember the name of the show. So, unless you're a baby boomer, or like me, I didn't have anything better to watch back then because we didn't have cell phones, we didn't have streaming video, we didn't have TiVo, we didn't have anything like that. And they didn't offer that kind of stuff on Blockbuster. You only had to watch it live. Then you probably know him as America's spokesperson for gold. Here, let me jog your memory for a few seconds.
Hi, Emily.
Hi, Mr. Devane.
How much you getting for lemonade?
$10.
$10. Now that's some serious inflation.
That is some serious inflation. $10 for lemonade, $20 for a Big Mac. And I've seen more than I can count. But there you go. This guy, and I had to look him up. This guy's 84 years old now, William Devane. He is still a stud in his 80s. Because you look at him then, you look at him now. I mean, it doesn't look that much different. So, where the hell am I going with this? All right. Well, it turns out that I'm seeing, and maybe you are too, more and more of these commercials on TV, and not just commercials with William Devane on it, but more and more. What are they pushing? Well, let's have a little more of a listen.
These days, you can really feel the effects of inflation. Gas is 10 times more expensive than it used to be. Even groceries cost you an arm and a leg. How do I protect myself against inflation like this? I buy gold from Roslyn Capital.
There you go. That's what he does. At least that's what he says he does. Now, not only this, but the amount of collector coin shows and some of this crap that says it's coming from the U.S. Mint are all of this is rising in airtime. I'm seeing more and more and more of this. And between M&M doing crypto commercials now, but we're seeing a lot in gold and a lot in gold and silver and collector coins. And let me set the table for you if it already hasn't been. Here's the kind of stuff that's coming out. Okay. Now, I'm not saying it's true or untrue. I'm saying this is what I'm hearing, and you're hearing it too. You're hearing things like the fact that America is more divisive than ever, especially with the upcoming election. In fact, Ray Dalio was saying on some interview that there's a 1 in 3 chance that the U.S. ends up in civil war. Now, I honestly think that's kind of aggressive, but if he said it, then he said it. Global conflicts, they're continuing. The U.S. is more likely to get dragged into more of these things. We've got illegals crossing the border at record numbers. This puts a strain on everything that goods and services in the U.S. How about inflation? I mean, it's come back a bit, but it's definitely a lot higher than the 1.7% it was back in 2021. It's a lot less than 9% it was at the end of 2022, beginning of 2023, but it's still high. The debt ceiling. Have any of you looked at the debt ceiling in the trillions and trillions of dollars that is part of the U.S. debt? It's unbelievable, and it almost looks unmanageable, especially with interest rates at the high they are now. I gotta imagine if you're the Fed and you actually are concerned about someone other than yourself or the group within the Fed, then you're walking a tightrope right now. I mean, they can't raise rates without raising the risk of recession, and they can't lower rates without raising the risk of inflation acceleration. And then I'm hearing stagflation is kind of being tossed around here and there. So you get that. Then look inside the U.S. For instance, I've got all this stuff I've been looking at here, and so here you go. Credit card debt back to highs never before seen, and there's people that are making over $100,000. What is $100,000 a year salaries, and nearly half of them are living paycheck to paycheck, and so you've got that. What else is going on? Houses. Okay, so I live in Florida. But houses in Florida and Texas, until recently, it was definitely a seller's market. It's a buyer's market in a lot of pockets now in both Texas and Florida. I think Austin, Texas saw the biggest drop in year-over-year home prices more than any other city in the country. And so we're even seeing it in Florida. We're seeing houses on Zillow are on Zillow longer. There is new construction. They overdid it, and now you got new construction in parts of Central Florida, and the home builders are now offering incentives, offering lower mortgages. They're doing rebates. They're doing all kinds of things to get these houses out of their inventory. I could go on and on, folks. But here's the question. What if William Devane is right? What if he's right? Let's talk protection for the last bit of my short podcast for today. I mean, right now, if you haven't looked at the price of gold, we're hitting all-time highs. All right, GLD just hit 225 this week for the first time ever. I've got 250 as my next target. That is what, 11% above where it is right now. And let me tell you why I think it's going to get there. Because there are a lot of people that have been playing this gold manipulation thing where when gold gets to those highs that they've been at, and the ceiling used to be in the 190s for GLD, and then they'd slam it back down to the 160s. 190s, 160s, 190s, 160s. So there's about a 30-point move there that short traders have been taking. Well, guess what's happened since the mid-190s got crushed? The mid-190s, we're now 30 points in the opposite direction for these folks that shorted this thing at 195, 197, 199. And they say to themselves, well, you know what? It's gone down 30 points. So if I did a 1-to-1 reward to risk ratio, betting on it going down again, if it went up above 30 points above my entry, then I'll get out. Well, guess what, folks? We're near that 30-point move. We're near a move for not only the conservative short traders in gold and GLD, but those aggressive ones that margined up. They might get margined out above 225. I think 227 is the number we're looking at. And so if we break above 227, I think we could be in the 230s very, very quickly as you see all of these buy stops kind of get huddled in for these short traders to get out and hold on to whatever is left. Okay? So what I'm talking about here is this continued move up in things like gold, the price of gold, the physical price of gold, gold bars, gold coins. They sell gold at Costco now. GLD. So silver bars, silver coins, SLV, the silver ETF. Which is best? Well, I like them all. Personally, I like them all. But there's something about GLD and SLV that I like more than anything else. And I'll share that with you here in a few minutes. But let's talk about what these are at and what this is likely going to cost. All right. So let's talk ETFs for a moment. So GLD is trading around 225. You know that one share of GLD is going to cost you $225. 10 shares will cost you $2,250. 100 shares, which is where I'm going to stay, $22,500. All right. If I buy GLD for $22,500, I buy 100 shares, put it in my pocket. What's my risk? What's my reward? What's my break even? Okay, because that's what we say as traders all the time. Risk, reward, break even, the RRB. All right. Well, the RRB, two of those three letters are hard to calculate when you are purchasing an ETF or even a stock. So what's my risk on gold? Whatever I'm willing to take. I mean, the absolute risk is that gold goes to zero, but I don't see that happening because it has a value. Someone will pay something for gold. So the likelihood of it going to zero is very, very low. So the next thing is, what is your real risk? So real risk in GLD, all right? Let's say, you're looking at a chart for the year. You look at a chart for the year and you say, well, where did 2024 begin with gold? All right. Well, it began the year somewhere just north of 190. So maybe you put that as a stop. So if you have 190 as your stop, well, we're 35 points below that. So possibly you could say, I'm willing to risk 35 points from 225. If we go to 190, I want out. It's a possibility. I mean, if you look at where it was back, let's say before COVID, before COVID, it was around 130, 130, 140. And here we are at 224. And there was a period of time in 2021, the back half of 2020, all of 2021, all of 2022, and half of 2023. We were still trading below 190. In fact, the year of the gold has been this year, 2024. We've seen a year. I have not seen a 6-month time frame where gold made this big of a move. You got to go back to 2016, where it popped off that low that was coming just off of 100, where we made that jump from 100 to about 130. Okay, we haven't seen a move like we're seeing this year. You've got to go back over 10 years to see that kind of a push. All right, so again, I could buy gold, but it's going to cost me. It's going to cost me $225 a share. What about the options? Tom, you're an options guy. What are the options costing us right now? Well, again, it depends on how long your hold is. But if you're looking at, if you're looking at things like global conflicts, or you're looking at things like inflation, or the debt ceiling, or the Fed, or stagflation, or what the consumer's doing right now, what they're not doing, and you're also looking at the election year, and you think that this election year is going to be kind of crazy, then maybe you're looking at options that go to the end of the year. Expiration is at the end of the year. All right. Right now, those at the money calls, those are the 225s that expire in December. They're going for about $13, which means it's going to cost you about 6% of the ETF price of GLD to rent GLD at today's price. What I'm talking about is by buying options with the December expiration on them, you're buying the 225 calls, which means what? You are expecting a better than 6% move in gold between now and the end of the year. And anything above that 6% you put in your pocket. Okay? Now, if you bought one call option, that's good for 100 shares of GLD. So that means you're going to control $22,500 for about $1,300. Okay? About $1,300. That's your cost. Now, what's your risk? Because we know risk in gold, cost is $22,500. Risk is going to be where you decide you're going to pull the trade off if it's not going in your direction. Reward is an open-ended argument. Where do you sell GLD? Okay. Break even is easy. That's where you bought it. It's always going to be where you bought it. If you're buying the asset, you're buying the ETF. But with options, it's a little bit simpler in so much that your cost is your risk. The $1,300 for one contract is going to be both the cost and the risk. And guess what? Gold could end the year at 225, and the person holding the ETF is at break even. But the person who bought the calls could have lost all of their money, because who wants to pay for a 225 call at the end of the year when you can buy the stock at 225 and there's no time value left? What you're buying is you're buying time premium. You're buying time because you believe gold is going to move a lot higher, a lot faster, and the price of that option is going to go up in value. So your risk is what you pay. Your reward is, again, also open-ended, but it does, unlike the ETF, it has an expiration date. The break even you're going to take the cost of that call option. You're going to add that to the strike price. So while the break even on the ETF is going to be where you paid for it at 225, the break even on a 225 call is going to be 225 plus 13. 238 is your break even at the end of the year. All right. So there you go. And that's just a couple of things. I mean, you want to go cheaper? Look at SLV. Where's SLV trading right now? In the 30s, I believe, 37. I believe that's the last time I looked at it. Oh, yeah. I mean, no, you know what I see it at? I see it at 27. Where did I come up with 37? I think 30s, in the 30s were a target I was looking at. But yeah, I mean, we're seeing it right now around that $29 area. So $29, all right? And then what are the calls going to cost you? The calls are going to cost you about the same thing. For the year end, you're looking at about 6%. So what's 6% of 29? Like $2, maybe a little bit more because silver's been kind of being the alpha here as of late. But, you know, let's say it costs you 10%. You've got to go 10% above the strike price by the end of the year just to get the break even if you're going to hold it to the end of the year. So what do you do? What do you do? I can't tell you what to do. I'm not your investment advisor. In fact, I'm nobody's investment advisor outside of my own family. Now, I own all of the above. But for liquidation purposes, owning GLD, owning SLV, having options on GLD or SLV, to me, make the most sense. Because unless all hell breaks loose, those are the easiest to get into and get out of. Ask people that own the physical asset. They can get out of it. If they go through a company they bought it from, they can sell it through that company. But if you're holding it in a safe or you're holding it in a safe deposit box, you got to physically sell that stuff, which means you got to put it on eBay of many things. And now all of a sudden, it's not instant liquidity. It's a 7-day or a 10-day auction. And then you got to hope that when you send it where it's going, that you get your money or that someone doesn't reverse charge you there on it. So, I mean, there's a lot of ifs when it comes to the physicals. You know, and if all hell breaks loose, food might become the most valuable commodity. But I don't want to go there. I want to sum up this podcast by saying this. If William Devane is right, then let's just say, like William Devane says, I like owning gold. But unlike him, I, Tom Gentile, like GLD even more. I'm Tom Gentile. I approve this message. And I approve the podcast. Hey, guys, happy Memorial Day weekend. I'll see you all again next week with our short market week. We'll talk then.